Good afternoon, everybody. It's my distinct pleasure to welcome David Wolf, the CEO of Hamilton-Thorne, to our conference today. In my humble opinion, Hamilton-Thorne is one of the highest quality small cap Canadian listed healthcare companies. As I'm sure David will highlight in his presentation, the company has a strong competitive position in the very attractive and growing assisted reproductive technologies market. Under his leadership, the company has a track record of growing faster than its end markets, as well as making strategic and accretive acquisitions. So with that, I'm going to hand it over to David to tell you about how he's been managing through the challenges of COVID and where the company is heading in the future. Take it away, Dave. David? I see that he's on. David, you're on mute.
All right, it looks like I've been unmuted, so thank you very much. Sorry for the small technical hurdle. I believe I've got control of the screen, so hopefully I can spin through my presentation, or if not, I can ask somebody to go to the next slide. Perfect. So as similar to Raj's presentation, I guess we have 20 minutes to talk about our company that we usually spend somewhere between 40 minutes and an hour discussing. So I'm going to go through pretty quickly. I will let you know this presentation is on our website, which is www.Hamilton-Thorne.Ltd. So for people who want to see the full presentation, and as I certainly skip some slides, be able to do so. Next slide, please. And next as well. So as Stefan mentioned, what we do is design, develop, manufacture, and market a wide array of products that are used in the assisted reproductive technologies field. We are US headquartered, but truly have a worldwide business. We are well positioned as a premium supplier of products in our field. We've grown, as Stefan mentioned, pretty substantially, about 35% CAGR over the past 5 years, through a combination of above market organic growth as well as acquisitions. We've completed 6 accretive acquisitions over the past 6 years, roughly on a pace of 1 per year. We see potential for accelerating that, but certainly we're not essentially a roll up where you might see an acquisition each month or each quarter. Just to give you a snapshot of our performance, we did just under $41 million of revenue during the 12 months ended March 31. I should mention that we report in US dollars. We are profitable with positive cash flow, very CapEx light business. So we generate a fair amount of free cash conversion, did 7.1 million of positive EBITDA in that same 12-month period. And we have a strong balance sheet. We have about $20 million in cash in the bank, plus a line of credit, which is used to fund our acquisition activities. Next. Thank you. So I'll spend a moment describing what is assisted reproduction. It is the range of technologies and services that can improve the rate of successful pregnancy. As I mentioned, we tend to focus on the IVF clinic and even more specifically on the laboratory of the IVF clinic. So just to be very clear, we are not providing patient-facing services. We're not doctors or clinicians. We provide the tools, the precision instruments and other capital equipment, consumables, and supporting services that are used by the laboratories of the clinics to deliver the results that they're looking for. To give you a sense of the overall size of our field, there are about 2.4 million assisted reproductive procedures performed annually. Next slide. And that translates into roughly $20 billion of spending at the provider level. So that, again, is what's spent on the physicians, the pharmaceuticals, a lot of areas that we don't participate. What we do is offer products, again, that are used in the laboratory, which is about a $1.2 billion addressable market. An interesting attribute of our field is that it is highly fragmented. both at the clinic level, where I won't spend a lot of time today talking about because that's not our business, but it's our customers, where there is consolidation going on. It's a little bit more or less in some particular countries, but on a worldwide basis, even the largest clinic chain is less than 2% of the overall clinics. Our side of the world, which is the supplier side, is also highly fragmented, a little less so as you imagine. But we track well over 200 companies that have participated in some way. Some are pure startups, some are very large in this field. And as part of our acquisition strategy, have identified over 160 that could be potential acquisitions for us. Now, some of them are a little bit larger. A couple large players are over $100 million of revenue. There's a mid-sized tier that are in our size, and we're sort of emerging from that tier to become one of the challengers, if not the challenger to the two larger players. And then a long tail of well over 150 companies that would be the kinds of companies that we would typically look to acquire. Not so much that we're unwilling to do one of these larger deals, but there's just so many more of those available. Next slide. So what is driving the growth of IVF? There are two dramatic demographic trends. One is that women are waiting longer to have children. And it's very clear that while fertility can stay pretty strong and stable during 20s and early 30s, it drops precipitously in the mid to late 30s. And as we've all observed with friends, family, or colleagues, that the need for assisted reproduction is there. The other dramatic demographic driver is that this trend that I've discussed is very well known and pronounced in Europe, which is, I'll show you another slide, perhaps the leader in IVF, certainly in North America. But I like to think of developing countries where they're beginning, particularly in those that are rapidly building rapid middle class. So I think of India as an example, where in the cities, the emerging middle class and professional class are beginning to behave like North Americans and spending their 20s and 30s establishing their careers, their families, get education, getting independent. And then when they want to have children in their 30s, they have the same physiological issues as everybody else. So India, again, is a fast-growing country for us, fast-growing market, but still on a per capita basis, very, very small. So enormous opportunity for growth. And of course, that middle class can afford to pay for IVF. Next slide. I won't spend a lot of time on the next two slides in the interest of time, but this is really to emphasize where we fit in our world. We are supporting the procedures that are used in the laboratory. Next slide, with a wide array of products, capital equipment, including some very unique and high technology systems like laser systems, imaging systems, consumables, the classic reagents and disposables that are used on a daily basis in connection with every procedure, and then the services to support both the capital equipment that we sell as well as services to support particularly the quality of products in the laboratory. Next slide. Again, this is something you might want to look at on your own, but I think, if you look at our business, we are about 85%, almost 90% of our business is in the human clinical market, again, supporting IVF clinics, though important parts of our business are selling products for the animal breeding and research markets. They tie all very nicely together and continue as we think about what comes next, our future growth. From a product mix perspective, a little less than half our business is capital equipment, and the balance is a mix of consumables and services. The capital equipment business is a tremendous business, very high average order size, great margins, but can have some lumpiness to it. So we've actually worked hard to offset that with a growing consumables and services business that has much more of a repeat and certainly in some cases contractually obligated recurring revenue component to it. So we think a nice portfolio mix of products. And similarly, from a geographic perspective, we've got a portfolio mix as well. Our largest, this sometimes surprises people, our largest geographic region that we support is Europe. But if you think back historically, IVF got its start in Europe. Some of the trends that I discussed in terms of age of for pregnancy for women is certainly more pronounced in Europe. And there's much more social support for IVF in Europe in terms of insurance and state-sponsored support. So the per capita usage of IVF is much higher. US, which is about 23% of our market, and Asia Pacific is the balance. We certainly expect to see greater growth in the Asia Pacific region and the US and other parts of the Americas over time. So I'm not sure that chart will ever quite get to 30, third, a third, and a third, but we would expect to see that even out a little bit over time. Next slide. We go to market through a combination of direct and indirect channels. We have major operations in the US, Germany, and the UK, manufacturing and distribution operations. We also have direct sales in France, which we've just launched, small outpost in Singapore, and we just completed an acquisition in Australia, which gives us additional coverage. We support the rest of the world through typically highly specialized distribution partners who are typically from the IVF field, know a lot about it, are able to be much more value-added resellers than pure, I would say, classic catalog-based distributors. I would expect over time that you would see more and more of those red pins turn to blue pins. By no means will we ever have 100% direct sales. Some markets are just too small. Other markets, frankly, we have great distribution partners. There's no need to displace them. But over a longer period of time, I think you will clearly see more and more markets where we have our own people. In terms of why our customers buy from us, I think it's really what our brand stands for. We have premium products. We obviously need to be price competitive from time to time, but we are not by any stretch a price leader. And we justify the pricing of our products by the reinvestment that we make back into the business. We spend around 6 or 7% of our gross sales, which is almost 25% of our profit back into R&D. And then we have a tremendous commitment to service excellence, the kinds of things that really lead to greater customer satisfaction. So that's a little bit about the products and the business and the markets. I'll segue a little bit to our longer term growth strategy, which I mentioned briefly has been through a combination of organic growth. Our field is growing about 7%. We've been growing well over 10%. I'll talk about, except for one quarter last year, where certainly we were impacted by COVID. But we augment that by a very active acquisition program. The purpose of our acquisition program is pretty clear. It's to accelerate the scope and scale of our business. The larger we are, the more important we are to our customers, the opportunity for operating leverage. We become, in some cases, it could lead to survivability because we have greater capabilities. We've also want to expand and have significantly expanded our product portfolio. So today, we're not quite a complete one-stop shop for the lab, but we can provide nearly everything that a lab needs. And through a combination of both our own product development and continued acquisition, we would expect to get to the point where we can provide most, if not all, of the high-value specialized products that are used in the IVF lab. We'll leave the commodity products to somebody else, but for those high-value specialized products, that's important for us. One thing that I think really separates our acquisition strategy from a number of other companies is the level of discipline and resources that we put to it. We have not a huge staff, but a dedicated staff working on acquisitions. We look at all of the acquisitions. We know the potential. It's not a huge universe. I mentioned about 160 companies. We've stack ranked them based on desirability and through a number of filters. And we make sure that we have active discussions going with nearly all of them at any time. Here's a list of some of the, or I guess the tombstones of some of the deals that we've done. Again, the presentation is on our website if you want to look at the details. But I think the two takeaways are we've tried to be very responsible in both sources and uses in terms of what we paid for these businesses. We're typically paying for these more established businesses between 5 and 7.5 times EBITDA. And for some of the smaller business, it's often a little bit on a multiple of revenue, and there we've been kind of 1, 1.5, and maybe nudging 2 times. So we're again very responsible about how we pay for these. And then on the sources side, we certainly understand that if it's great to be a public company and it's great to have access to the market, but it's not great for shareholders if every time we do a deal, we go out and raise money in the market and create additional shares. So we're very clear and careful about how we think about our weighted average cost of capital, use our own cash, which we generate from operations, bank debt, which is available to us, seller participation, whether it's a debt or equity, and then of course we have used the capital markets from time to time when we need equity. Here's a view of our last 12 months. I think, as I mentioned, we did have a pretty significant COVID impact. If you look at Q2 of last year, we saw our sales shrink for the first time in certainly my memory of the business. But certainly over Q3, Q4, and into Q1, we saw a rebound. I know one of the themes of this conference is how COVID both has affected us and what the resurgence can look like. So clearly, as a worldwide business, a lot of our business in Europe and Asia, we're not running at 100% in all markets. In the US, well, the Americas, we do announce the number and don't break it out specifically for the US. Just to give you a sense of Q1 of this year was up over 30% versus Q1 of last year, where our overall business, while it was up over 10%, was a little bit less. Again, you can view this in the presentation. I'll finish up with a little bit of a summary of our capital structure. We have just around 140 million shares outstanding. We have a very clean cap table. We do have stock options and RSUs that have been granted to our loyal employees and officers and directors, but we don't have, and by the way, these are fine things to have, but they do make the cap table more complicated. We don't have warrants. We don't have convertible securities. So we've got a very clean cap table, only common stock and common stock options. And then on the balance sheet side, we have, as I mentioned, over $21 million of cash and relatively modest debt, about $7 million of debt, all of which is bank debt, some of which was government supported, so zero or very low interest, and even the balance, which is bank debt, ranges from around U.S. prime to at a max for some of our term debt to 4.5%. On the shareholder side, we've got a nice mix of shareholder ownership. About 25% is owned by management and directors. So again, I think strong aligned interest with shareholders. 25% is classic float, and about 50% is institutional ownership, a combination of US and Canadian, and some actually becoming a growing amount of European institutional ownership. Our share price has been growing. We've actually been on a great run this year. So we were, I guess, a low for the last 12 months of $1.10 and a high of over $2. We're trading about $2 right now, which gives us a market cap of about 270-ish US, Canadian, about 220 US. Our goals for the balance of this year, actually very similar to our goals for last year. We want to continue our strong profitability and positive cash flow and continued growth. We are focused on accelerating organic growth. We are making investments in increasing our direct sales teams, launching new products, adding new territories. We obviously want to increase awareness in the capital markets, both to increase liquidity and bring in new shareholders, hence the reason we are delighted to have been invited to do this presentation. And of course, the continued and disciplined execution of our acquisition strategy. So I thank you very much. I think I brought this in just around 20 minutes, which might be a world record for me. And I'm happy to answer any questions that I can.
That was amazing, David. If you exclude the 5-second little issue at the beginning, you hit exactly 20 minutes, like to the second. So good job there.
Thank you
for doing that and sticking tightly to the time limit. I just want to remind everyone you can ask questions through the Q&A function, and we already have one in the Q&A function, and I've received a couple of emails. So the first question is, who are the other 8 supplier companies that you mentioned, and maybe talk a bit about, in a little more detail about maybe the 2 bigger ones and the other ones that are more sort of your more immediate competitors from that perspective.
Sure. So I think that's a great question. I'm trying to toggle back to that slide. I gave up control. So if whoever's in control could put me back on slide 5, that'd be terrific. So the way our competitive universe lays out, as I mentioned, there are well over 150 companies that we that are in our field. To some level, we compete with every single one of them on, in a given geography and a given product line on a given opportunity. But clearly, you see more of the larger players. The two larger companies are interesting in their own way. Vitrolife, which is publicly traded, symbols VITR, is as best we can tell, is the largest player in our field. They're, I think they did about $130 million on a trailing 12 months basis. So, again, bigger than us, but by no means a dominant player in the market, have an enormous valuation. Some of it, I think, is, well-deserved, larger business. They've got a, greater scale, so greater EBITDA margins. But I think they're also, I'm not sure we'll ever get exactly to that valuation metrics, but they're a, good example of what we might be able to look like at a larger scale. The other large company is a little bit harder to determine exactly what they're doing. It's the Cooper companies, Cooper Surgical Division. They do break out some numbers in their public reporting, but it's thank you. But it's not as robust reporting, so we don't know anything really about exactly, because they also include some parts of the business that we wouldn't consider part of our addressable market. So it's not exactly apples to apples. Of the mid-sized players, a few of those I would say are, well, the 8 includes us, so, but a few of the 7 balance, a few of those are more horizontal players. So I wouldn't see us, they're important in our market. We either compete or collaborate with them. So I'm thinking of companies like microscope companies like Olympus and Nikon, where they provide tremendous amount of product that is used in the IVF lab. And everything we're talking about is, microscopic in size, tiny in size, measured in nanometers. You need to take a look at it under a microscope. But we're not going to buy Nikon, and they're not going to sell off their IVF divisions. It's really essentially the same microscope they sell into other products. The balance of them are companies you probably would never have heard of, but they're big in our field. Japanese company called Kitazato, a Singapore company called ESCO, U.S. company Cook Medical. It's actually a very, very big company, but it's a small part of it, privately held. And then again, there's 100 so, and we do talk to all of them at some level and have a business relationship with many of them. In some cases, they're our customers. In some cases, we're customers of theirs. In some cases, we collaborate with them because customers want a complete solution. But again, when I think of our typical acquisition program, most of the companies we've bought, or I guess everything we've bought up to now, have been 20 million of revenue or less, and there being so many more targets of opportunity there, I think it's more likely that that's where we would participate in the future.
Great. So just while you're sort of finishing off on M&A, question came in by email. You talked about the type of companies you look at, but you didn't really talk about sort of, do you have a geographic focus as you talked about your balance of where your revenue is coming from. Are you looking to expand in markets where you feel you're a bit maybe underpenetrated, like Asia? You recently did a small acquisition in Australia. It was quite small. Is there a shift in your focus to those geographies?
Yeah, so from an M&A, that's a great question. From an M&A perspective, and I think in almost everything we've done, we've been pretty methodical about this. So our first acquisition was essentially a product line acquisition we bought from a division of Perkin-Elmer. I think they were 20 minutes down the road from us. So, a local business, company we knew, we had sold that product, we had just a great deal, a high level of confidence that we could complete that acquisition properly. Next acquisition, another US-based business, a little further away, but nevertheless one that, it's not that we were completely cautious about it, but if you needed to, you could go drive to it and solve problems. As we've expanded our business and expanded our scope, we've done a couple of acquisitions in Europe. And as you mentioned, we most recently bought a business in Australia. So in terms of geographic, I would say if you asked me the question 3 years ago, I would have said we're pretty focused on US and Western Europe. Right now, I think we've got to a scale, and the market has evolved as well, but got to a scale where we have a worldwide focus.
Great. So we've got a couple more questions that just bounced in on the Q&A. So I'm gonna jam them into one question. One is, how many deals do you expect to do per year? And what sizes are you contemplating? And then the next question, which follows logically, what level of debt to EBITDA are you comfortable with as you contemplate more deals? So I've turned two into one.
Yeah, so I think I can answer those in pretty consistently. So as I said, given the nature of our target universe of potential acquirees, it's more likely that we'll be doing deals on the smaller end. Maybe ones with $5 to $10 million, maybe a little more, maybe a little less of both. I guess of purchase price, and then revenues will be a little bit less than that. In terms of our capability to finance those, we have, as I mentioned, over $20 million of cash on hand. We do have a dedicated acquisition line of credit as well as a very supportive bank. From a covenant perspective, we're limited to up to 2.5 times EBITDA. We're very comfortable at 2.5 times EBITDA. I would say we're comfortable higher than that if we were looking at a short-term situation. So I could imagine, for example, we find a company that's got tremendous cash flow, not CapEx, not a lot of CapEx coming down the pipe. Perhaps we'd go up to 3.5 or a little bit higher in terms of leverage, but we would want to have a pathway to see how we could get back to a much more comfortable for us leverage ratio. So what that implies, if we end up doing more than a couple of acquisitions within a relatively short period of time, if they're on the small end, we can do that with available resources. If they're on the larger end, we might look at having to access the capital markets, because we look at everything as in a holistic fashion, weighted average cost of capital, as well as our comfort around cash flow and leverage.
Great.
I think I hit all 4 parts of your 3-part question.
You're doing great, and you're keeping it tight too. I like it. I have another question here. I've heard about private equity rolling up IVF clinics in the U.S. What does this mean for your business, and is this having any impact on your operations? It's a very good question.
Great question. So IVF, private equity is rolling up, and as well as some clinics that are looking to expand through their own efforts, are rolling up clinics on a worldwide basis. So there are active IVF roll-ups in the US. In Canada, there's actually a pretty active IVF roll-up. UK, parts of Europe, Australia is almost completely rolled up. So, again, in certain markets, we see a significant concentration. Thus far, one of the things you would worry about, of course, is that changes a little bit of pricing power and dynamics, which, so thus far it hasn't really been a factor. There's been some, obviously, larger companies want to get good deals and sometimes better deals. The other side of that, though, I think it actually plays to our advantage, is one of the flip sides of trying to get better bargaining power is reducing your number of vendors. And we're one of a really small handful of vendors that can provide, in the markets where we sell direct, certainly everything that is used, or virtually everything that is used in the clinic. So if a roll-up is trying to look at, improve strategic sourcing, typically it's not just beating vendors up for price, it's convincing vendors that will source more from you, therefore it'll be lower cost for you, and we'll end up, both of us, having some kind of benefit out of that. And if you look at that list of 160 companies, even some of the larger companies really have fairly narrow product lines. So there's really only a handful of that 160 can play in that game right now.
Wonderful. So we've bumped up against time. So that's been great. Thank you for your time today, David. Great presentation. I want to remind everybody that Hamilton-Thorne trades on a TSX venture with ticker HTL. We buy rated with a 225 target price, $2.25. So thanks again for your time today, David. So with that,
my pleasure. Thank you very much.
Yeah, we're going to pause for a few seconds and queue up the next speaker. I'm going to hand off to my colleague, David Crystal, our real estate analyst.